Welcome to Group Insurance Daily Pulse, your rapid-fire, data-driven download of the most critical developments impacting the group benefits landscape. I'm Arya, the actuary, here to dissect the P&L implications, regulatory friction, and solvency risks.
And I'm Dorian, the distribution expert, ready to spotlight the ROI, market share opportunities, and employee experience enhancements. Let's dive into the bytes.
First up, a significant move from a major global player, IRDAI. The Insurance Regulatory and Development Authority of India has established a 7-member working group on artificial intelligence for their insurance sector, effective June 18, 2026. This is a proactive, forward-looking initiative, signaling a structured approach to AI integration. We're talking about developing governance frameworks, best practices, safeguards, and crucially, an AI audit framework, all specifically for insurance use cases. This isn't just a local story, it sets a precedent.
Proactive and structured are admirable adjectives, Dorian, but my immediate focus is on the frameworks, safeguards, and audit requirements. IRDAI expects recommendations within 3 months. That's an aggressive timeline for developing comprehensive, actuarially sound AI governance that can withstand scrutiny.
Precisely, Arya, but consider the upside. A clear, well-defined framework mitigates uncertainty. This translates directly to accelerated, responsible innovation. For brokers and employers, this initiative promises new AI-driven products and services that are not only innovative, but also transparent and responsibly governed. Think about the potential for increased efficiency in benefits administration, streamlined enrollment, predictive analytics for group health risk management, and hyper-personalized benefit recommendations.
Hyper-personalized sounds appealing, Dorian, but it screams data privacy and algorithmic bias risks. How will these frameworks address the potential for discriminatory outcomes in underwriting models or claims adjudication? Will there be specific provisions for explainable AI, XAI, to justify decisions to policyholders and regulators? The audit framework, while necessary, will impose substantial internal control requirements and likely necessitate specialized AI ethics committees. The cost of noncompliance, particularly concerning data integrity and consumer protection, could be astronomical, impacting P&L directly through fines and reputational damage. My concern is the speed at which these frameworks are being developed. Are we sacrificing robustness for expediency?
Expediency is often a market differentiator, Arya.
De-risking adoption is one thing. Guaranteeing actuarial soundness and regulatory adherence across diverse AI applications is another. The interplay between these new IRDAI guidelines and existing global data protection laws like GDPR or domestic DOI regulations adds layers of complexity. We need to ensure these AI models don't inadvertently create new categories of uninsurable risk or expose carriers to unforeseen liabilities. The devil will absolutely be in the details of that audit framework.
Shifting gears to market performance, Unum Group has reaffirmed a strong 2026 outlook following robust Q1 performance. This is a clear signal of a healthy and growing market for group life, disability, and other workplace benefits. They're projecting total premium growth of 4 to 7% for the full year 2026, with adjusted operating EPS expected between $8.60 and $8.90, reflecting an 8 to 12% growth.
Healthy and growing is one interpretation, Dorian. My analysis dives deeper. Unum reported an 8.53% year-over-year revenue increase and a 22.69% rise in net profit for Q1 2026. While impressive, we need to understand the drivers. The U.S. group business showed strong momentum, with sales up 22% and persistency at 92%.
Those are valid points, Arya. But the strength in group life and AD&D adjusted operating income hitting $115.1 million in Q1 2026 is particularly noteworthy. The favorable benefit ratio of 61.8% against an outlook of 70% indicates exceptional underwriting discipline and claims management. This isn't just growth, it's profitable growth. For other carriers, this underscores the imperative for strategic investments in technology and operational excellence to capture market share. Unum's digital-first total leave platform is a prime example of leveraging tech for both efficiency and enhanced employee experience, which ultimately drives persistency.
8% benefit ratio against a 70% outlook is indeed favorable, but it begs the question, is this a temporary anomaly or a sustainable trend? actuaries are inherently cautious. We need to scrutinize claims experience, reserve adequacy, and potential changes in morbidity or mortality trends. Is this ratio driven by favorable incidence, duration, or severity? Any shift could quickly reverse profitability. Furthermore, while technology investments like the Total Leave platform are critical, they come with substantial upfront capital expenditure and ongoing maintenance costs. What's the projected ROI timeline for these transformations, and what are the cybersecurity implications of a digital-first platform, especially concerning sensitive employee health data? The P&L impact extends beyond just premium growth. The ROI on digital transformation is multifold, Arya.
A virtuous cycle that must be underpinned by robust risk management. A financially sound provider today could face solvency challenges tomorrow if their underwriting assumptions shift, or if their technology investments fail to deliver the anticipated returns, or worse, expose them to significant data breaches.
The market is healthy, yes, but it's also intensely competitive. We need to understand if Unum's strong Q1 is indicative of systemic market strength or specific competitive advantages that others will struggle to replicate or afford.
Our final segment brings us to Washington State, where significant updates to the Paid Family and Medical Leave (PFML) program took effect January 1, 2026. These comprehensive regulatory changes are designed to enhance employee benefits and offer greater flexibility, which ultimately supports employee retention and overall experience. The minimum duration for claiming leave, for instance, has been reduced from 8 hours to 4 hours.
Enhanced flexibility and greater support are certainly the stated goals, Dorian, but the actuarial and operational realities for employers are considerably more complex. The premium rate increased to 1.13% of each employee's gross wages, up to the 2026 Social Security cap of $184,500. This is a direct hit to both employer budgets and employee take-home pay. The allocation mandates employers pay 28.57% of the total premium, while employees contribute 71.43%.
True, there are adjustments, but the enhanced job protection for employees taking leave from employers with 25 or more employees, regardless of whether it concurs with federal FMLA, is a huge win for talent acquisition and retention. Furthermore, the requirement for employers to maintain health benefits during job-protected PFML, provided the employee continues to pay their share, creates a more secure environment for employees during challenging times. This is a differentiator for employers in a competitive labor market.
A differentiator that carries significant compliance risk and administrative burden, Dorian. Maintaining health benefits during leave, irrespective of FMLA concurrence, means employers must meticulously track leave types and durations.
This demands sophisticated HRIS and benefits administration systems. For employers with 25 or more employees, the legal liability for non-compliance with job protection and benefit continuation is substantial. We're talking potential lawsuits, fines, and back pay. And let's not overlook the reduced minimum leave duration to 4 hours. This could significantly increase the frequency of claims and administrative transactions, straining internal HR resources and potentially impacting productivity. But for brokers and TPAs, this presents a critical opportunity to become indispensable partners. They must ensure their clients are fully informed and compliant with these changes to avoid penalties. Offering robust support and navigating this updated legal and administrative landscape of employee benefits isn't just good service, it's a revenue-generating necessity. It's about translating regulatory complexity into actionable, compliant solutions for employers.
Actionable and compliant are key, Dorian, especially with penalties for past due reports and interest on overdue premium balances commencing on August 1st, 2026. That's a hard deadline. Brokers and TPAs face increased professional liability if their guidance leads to client noncompliance. My concern is the potential for increased claim frequency with the 4-hour minimum, which could lead to higher overall program costs and necessitate future premium adjustments. The actuarial lidls for PFML programs are still maturing, and such significant changes introduce volatility. Employers need to be prepared for the P&L impact of both the direct premium costs and the indirect administrative and compliance expenses. This isn't just a benefits update, it's a fundamental shift in employer obligation and risk profile.
And a shift that, when managed effectively, strengthens the employer-employee social contract, leading to greater loyalty and productivity.
It's a net positive for the workforce, and savvy businesses will leverage it at a substantial, quantifiable cost. And that's all the time we have for Group Insurance Daily Pulse. Join us next time for more technical insights.
Stay informed, stay ahead.